Morning, everyone. I'd like to call the September 18th meeting of the California Housing Finance Agency Board of Directors in order. And with that, I'll ask Courtney to please call the roll.
Certainly, and I just want to remind all members to please turn on your mic today before speaking so that the audio is picked up for recording and for Norena. Thank you. Chair Cervantes,
Present.
Ms. Cabildo, Ms. Kurgan for Secretary Moss,
Present.
Mr. Hardiman,
Present.
Ms. Limon,
Present.
Ms. Wyant for Treasurer Ma,
Here.
Mr. Prince, Mr. Russell,
Present.
Secretary Sin,
Present.
Ms. Sotelo,
Here.
Director Velasquez,
Present.
Dr. White,
Here.
Mr. Williams,
Here.
Mr. Fano for Director CalHFA,
Here.
Ms. Peralt, and Ms. Franklin.
Present.
The quorum.
Terrific. Thank you very much. I'd like to move to the second agenda item, which is that Director Limon has informed CalHFA that she is unable to attend in person due to physical condition. And under Government Code Section 11123.2J2, this qualifies as a circumstance under which remote participation is permitted. Director Limon will participate via Zoom. Director Limon, are there any adult individuals present in the room with you?
There are not.
Thank you. In order to proceed, the board must vote to approve her remote participation, and I will entertain a motion to allow Director Limon to participate remotely.
So moved.
I second.
Thank you, Directors Williams and Russell. Courtney, can you please call the roll?
Tays.
Yes.
Ms. Kurgan? Yes. Mr. Hardiman?
Yes.
Ms. Wyant?
Yes.
Mr. Russell?
Aye.
Secretary Sin?
Yes.
Ms. Sotelo?
Yes.
Director Velasquez?
Yes.
Dr. White?
Yes.
And Mr. Williams.
Yes.
The motion is approved.
Thank you all very much. The next agenda item, we have minutes from our last meeting on August 21st, the board meeting and the workshop. I'd like to see if they're in their package. I'm sure we've all reviewed them. Does anyone have any comments or corrections to the minutes? Seeing none, I'll entertain a motion to approve.
So moved.
Thank you, Director Russell, on the second. Thank you, Dr. White. Per our protocol, with a motion to approve and second, the minutes were deemed to be approved. And with that, we can move on to our next item, which is Executive Director and Chair comments. So I'd like to note a couple of things with respect to this meeting. We've had to make some changes to the agenda. Two items have been removed. The first is the closed session, and the second is the Shiloh Terrace permanent loan increase. We anticipate that the latter will be rescheduled, and we'll see it at the October meeting. I would also like to note, shifting gears, that the Executive Evaluation Committee, in as much as we have not had a permanent executive director since November of last year, we really have had no reason to have the committee meet. And I would put out there that given the absence of relevant topics, we will forego convening the committee this year, and we'll continue to monitor developments and call a meeting if anything comes up that needs to be brought to the committee's attention. So just to let you all know what stands with the EEC committee. And then finally, I want to turn this to Rebecca, but before I do, I really need to compliment staff for the terrific work in organizing last night's 50th anniversary event. It was really terrific. It was a warm evening in more ways than one. Once we got over the temperature, I think the feeling was really that of great warmth. And I think a love for what we do, going back the 50 years of this organization's history, a love for the contribution that we all make and our partners make to providing housing for Californians, and continue that mission that the governor's charted out to sort of make the state more accessible to everyone who lives here. So I just felt really great about it, and was delighted with the videos that were prepared and just the the chance to mingle with individuals that we all work with. It was really a terrific event. And I'd love to see, I'd love to be around for the next 50th one, but I'm not sure I'll make that. But in that case, Rebecca, could you please,
At least another 10.
at least another 10, I'll take that, thank you.
Thank you, Chair Cervantes. I also want to acknowledge all of the board members who took the time to celebrate and attend last night's event. I also want to acknowledge the amazing staff at CalHFA who, we talked about it last night about they come to work each day with such sense of pride in purpose and in fulfilling our mission, but also doing these great things such as the event. It's just a small taste of the amazing work that they do on the daily basis. Big shout out to our marketing and communications team because they were really the backbone of the event and put all those finishing touches together and really just they have a lot going on. We have a lot going on, and that was a little extra to their workload for the past 6 months, and it really came together really nice. I also want to say that I guess when I think about last night and kind of my tenure here, the word that comes to my mind is lucky. I'm lucky to be here. I'm honored to be in a position where I get to serve Californians and provide such a wonderful opportunity as, bringing people home, bringing a safe space to put over someone's head, or even establishing themselves as a homeowner or maintaining their homeownership is just really something truly great, and I wake up each day feeling honored that I get to be part of those processes. I also want to recognize that, we have made such a credible impact. We shared some stats last night. 230,000 Californians have been helped to establish homeownership, 85,000 affordable units created in 50 years. It's really amazing work that, we're all part of, not this board, the staff, the larger part of the housing continuum with our partners at HCD and in the administration. But it's really cool to see that there. Oh, the other thing I really thought about last night was I got to connect with a lot of our lenders in our lender network, and I don't necessarily get to see them a lot. I know our single family staff does, but it was really, I get to interact more with the development community. So it was nice to connect with the other side of the house a little bit. So, I know that we're taking a moment of reflection to see that what we've all accomplished, but I really think that this is the opportunity to see what we can accomplish in the next 50 years, and that take this and all that we have accomplished and use it as an inspiration point to do bigger, better, and more. Talking about events, I've been a little busy in the last month for my event schedule, and I think September might be a little bit even more busy. The last couple of weeks, I delivered remarks for the Assembly Select Committee on Housing, Finance, and Affordability. I spoke on a panel in front of students at the UCLA Zinman Center's Affordable Housing Development Program. I will say, I like talking, obviously, but the panels are fun, but I think speaking to young, creative minds and people that are trying to break into this space is really just the biggest honor of all of these. I also got to participate on a very fun and lively panel, I will say, at San Joaquin Valley Housing Collaborative Affordable Housing Summit in Fresno. That was really, I had actually never been to, I've only lived in California. I've never been to Fresno proper. And so, that was kind of interesting. It was fun to go out and see a city that we talk about, yes. And, there, additionally, it wasn't just me busy this month. Director of Homeownership, Ellen Martin, spoke on a Turner Center webinar that is focused on innovative strategies for increasing access to homeownership. And representatives from CalHFA participated in the Southern California Association for Nonprofit Housing, or SCAMP, annual conference. They made themselves little Lego people. I thought that was the cutest thing. I was like, you guys don't have to beat the booth, just keep the Legos. Then next week, we're back on the road as Ms. Martin and our Director of Financing, Erwin Tam, will be participating in Fannie Mae's Affordable Lending Conference in Washington, D.C. Our fantastic and my favorite General Counsel, Claire Tarianen, will be attending the Western States HFA Directors Exchange in Boise, Idaho. And I will be attending, as well as our Director of Risk Management and Compliance, Kelly Matson, and our Director of Legislation, the Novogradic Housing Tax Credit and Bond Conference in Nashville, Tennessee. Finally, all the folks and several others will be, all of the directors and a few of our board members, Dr. White, Director Hardiman, and then Ms. Kurgan are going to be joining us in early October for NCSHA's annual conference. Not only are we getting to go to the conference and learn and engage, but we've actually been asked to speak on, I think it's 5 panels. So I myself will be moderating a panel called AI in Practice, Real World Applications for Agencies and Partners. It will be like a therapy session for leaders across HFAs about AI is here and we are going to welcome it and make use of it and love it. Mr. Tam will present as part of a Managing and Maximizing Your Financial Resources panel. Our Chief Information Officer, Ashish Kumar, will present the California Dream for All portal as part of the Digitizing the Front Door, How to Modernize Program Access. Our comptroller, Oksana Gluchenko, will present as part of the Best of HFA Internal Operations panel, which maybe is a good sign to some awards that we have put in. And then Ms. Kurgan is also presenting at NCSHA on a disaster recovery and preparedness panel for housing, which they are, NCSHA is very interested in what California does on in that disaster recovery rebuild space. And I think we've at CalHFA have done a lot of really great work with the most recent disasters as well as our partners in HCD. So I think she'll be highlighting a lot of the work that both agencies do in response to disasters. That's kind of what we're doing to keep ourselves busy while we're doing our other jobs. But I just wanted to also acknowledge and thank everyone for the great engagement at the workshop last month for our strategic plan. We continue to develop our plan, and we heard you. We understand, I think, kind of the challenge that the board is wanting us to meet. Also talking about kind of how we can make the structure of the plan a little bit more, not only pushing innovation, but also maybe like making sure the goals are a little bit more specific into the areas we really want to get to and making the measurements really count. We will be, with the executive team at CalHFA has taken this information back and we will be processing it, and we will kind of give the board we'll have another conversation probably in February of where we're at, taking the feedback we've gotten over the last couple of conversations for the strategic plan. Lastly, I will close my comments with an update on the CalAssist Mortgage Fund. It is continuing to provide relief for homeowners who've survived recent disasters. As of this week, we have sent out funds to help over 200 homeowners, 80% of which have suffered and survived the Eaton fire, and 70% was the Palisades fire. We do also have been able to help homeowners outside of the two major fires that were happening in January of earlier this year. We continue to do outreach on multiple fronts and encourage applications. In fact, I was interviewed last week for a segment on Spectrum News 1 Los Angeles. So we're continuing to talk about it. We're continuing to there. I think I shared with the board, I was on a plane a couple months ago and the guy lived in Long Beach and he was telling me about this program he heard of. So, I mean, we're trying to get the word out there. So that's really cool. We are getting a lot of feedback, and I know board members have also received feedback on some of the criteria of the program. And we will be looking to kind of modify or change a couple items going forward just to make sure that we're, when we do the relief programs, we want to make sure that we're very targeted and specific in getting the funds and the opportunity to apply to those who are most in need. And then we kind of try to broaden things out a little bit. So I think coming in the early part of October, the board will see that we will have maybe readjusted a little bit of the criteria on the program itself. And with that, I conclude my comments, and I will let us get back to the next agenda item and turn it over to the chair. Thank you.
Thanks very much. There's clearly a lot going on. You and staff have been very busy, so that's great. Keep up the good work. Agenda items 5 and 6, as I mentioned earlier, staff has determined that there isn't a need to convene a closed session at this time. We'll pick this up later. So we'll defer 5, 6. Yes.
Can we ask for an update on this situation with the purchase?
No. I mean, yes. So the item was agendized in case there was anything of note that we needed to bring to the board for council on any during the due diligence. We're in the middle of it, so there isn't anything that's running according to plan. We are getting the information we need to be able to make the decision based on the action item the board took at the last meetings and the feedback given about kind of what we should be kind of turned to. But at this time, we don't have any substantial updates to share.
Okay.
Thanks for the question, though. Item 7 is a report from the Audit and Risk Management Committee, which met earlier this morning. And I'd like to introduce Delilah Sotelo, who's the chair, to present her report.
Great. Thank you very much, Chair Cervantes. I appreciate everyone's patience and the committee's participation. We had our 2-hour meeting that turned into an hour and a half because we were so efficient. So thank you very much. I'm pleased to report that the committee has completed a comprehensive and competitive selection process for CalHFA's Independent Audit Services contract. Let me give you a little bit of background. The selection process began actually February of 2025 with an RFQ that was released in June of 2025. The agency received a total of 5 proposals, at which time they conducted a material evaluation of those proposals to meet baseline threshold requirements. And based on that review, it was recommended that 2 firms actually proceed to the next phase, which was the interview process. For the first time, the Audit and Risk Management Committee was involved in the actual interview process and is the active committee that made the selection of the auditors. So it is a very momentous period for the board that we have direct involvement in the selection of our auditors. And so I think that speaks to the transparency that we're trying to create within the organization. So this morning we conducted the interviews for each of the firms, and we basically focused our attention on 8 questions that we standardized between both firms, and the committee members took turns in asking the questions. We allowed the firms to have an opening statement and a closing statement, and there was one firm that took full advantage of it and did very well. And both firms were very qualified, had good experience. Their approach and their team capabilities were both very strong, but there was one clear winner, and the committee has decided to move forward on the selection and recommendation of one of those firms. The 2 firms that were interviewed were Eide Bailly, which is a national firm, and the second firm was Macias, Genie, and O'Connell, also known as MGO. And both firms, like I said, had experience, well qualified, good staff capacity, but the committee unanimously voted, and MGO was the firm that we are recommending to move forward. So Macias, Gina, and O'Connell will be the firm that staff will be negotiating with, and at the time that negotiation of a contract concludes, then we will transition into the new firm. So we anticipate that that process will take us through the end of the year, and hopefully in January we will have a new firm that's selected. So I'm very excited about the work that Oksana, Sandra, Shelby, and all the team did to really make this RFQ and this process as comprehensive and iterative as it was. Like I said, we started back in February, and the focus and the determination of the staff to keep it clear and transparent and fair was very admirable, and I appreciate the engagement of the audit committee through the entire process. So I will ask my fellow committee members if they wanted to add any information to help, but for me, I just wanted to thank again the staff and Ms. Franklin for the guidance and the opportunity to participate. So Dr. White or Ms. Wyant, have you guys had any comments?
I will just reiterate my appreciation for Oksana and team in putting together such a robust process and listening to the committee in terms of getting us involved. I feel pretty comfortable with how we went about this and the decision, so.
Yeah, same. Just thank you, staff, and both of the candidates were excellent and would have done a great jobs. But I think we all kind of some of the same points resonated with us from the firm that scored highest.
Great. So with that, again, congratulations to MGO for being the selected firm, and congratulations again to staff for your process. On an additional note, the committee reviewed its charter. There were no additions or changes to the charter. We don't anticipate having another committee meeting until potentially December, maybe February of next year. So thank you very much.
Thank
Chair
you.
Cervantes.
Are there any questions or comments from members of the board on this topic? So maybe just one clarification for me. So MGO got the nod. Is there a contract, once it's all settled out with them, is there a contract that comes back to the board for approval, or is it just a go?
No, it's just a go. So the contract gets negotiated based on, terms of the agency.
Okay, thank you. Thank you for clarifying. Unless there's any questions or comments from the board, I'll ask if there's any public comment on this item.
If any members of the public would like to make a comment, please raise your hand or come forward. There's none at this time.
Thank you very much. Agenda item 8, as I mentioned earlier, this is the Shiloh Loan Terrace loan increase application. Is being deferred. It will be considered likely at our next meeting. So we'll see that in a month or so, I expect. And with that, we're at agenda item 9, which is the update on the 24-25 single-family programs. I'd like to have Ellen Martin, our Director of Home Ownership, come up and make her presentation. Thank you.
Good morning, Mr. Chair and members of the board. How's the volume? Is that good? Okay. My name is Ellen Martin, Director of Home Ownership for CalHFA. So for this presentation, I will be offering an overview of the single-family programs, specifically the down payment assistance programs, with particular attention paid to the performance of those programs in the last fiscal year. One of the goals of this presentation is actually to answer some of the questions that the board has asked regarding the new My Access program. So I hope you'll find that the coming slides do address some of those questions. So with me today in the audience, I have Molly Ellis, who is the head of our Lender Services Division. She is celebrating this month her 27th year with the agency. So first of all, I want to congratulate her on that. And then she will be available to the board if you have any questions. If you manage to stump me, you probably won't stump her. So. If we can move into the next slide. So I'm going to try to advance these myself, and if I have any challenges, I'll turn it over to Tal. So a quick overview of where we are going. I will start with a brief and likely highly oversimplified overview of the single-family down payment assistance programs, our business model, just to kind of set the stage and level set. I'll then move into some historical performance metrics, followed by a bit of a deeper dive into the performance of our programs in fiscal year 24-25. This presentation is really intended to be a complement to the Dream for All presentation that I provided last month. So I'm not going to repeat any of the Dream for All specific program metrics, but what I'm hoping is that this presentation kind of helps to place that program in context with our other down payment assistance programs. So the single-family team has been very active over the last few years, actively standing up many new programs. As shown in this slide, we've launched 2 phases of the ADU grant program, the State Route 710 Affordable Sales Program, the Forgivable Equity Builder Loan Program, 2 phases of Dream for All, the My Access program, and most recently, a suite of refinance offerings. So with the addition of these program offerings, CalHFA has successfully dispersed nearly $700 million in general fund revenues general fund monies and has worked to create a suite of single-family programs that are designed to really meet various homebuyer and market segments with the overall intent of ensuring that we have a diversified program that remains relevant and can be sustained over the long term. So moving now into some specifics regarding our key down payment assistance programs that I'll talk a little bit more about today. So the overarching mission of CalHFA's single-family programs is to help low and moderate income Californians, first-time homebuyers, access sustainable homeownership. So when we talk about sustainable homeownership, what we really mean is we don't just want to get borrowers into a home, we want to make sure that they are well positioned to maintain and sustain that homeownership over the long term. So for that reason, we pay very close attention to things like loan terms, underwriting standards. We require homebuyer education, we require home warranties, and we offer post-close financial counseling. So we really want to make sure that through those actions and through the design of our programs, we're setting up our borrowers to be successful over the long term. We have two main down payment assistance programs. We've talked a lot about Dream for All in recent months and years. What we don't talk about as much is our flagship My Home program, which offers up to 3.5% down payment assistance. And then we have a couple of third lien programs that are associated with that My Home program. That includes the Zero Interest program, also known as ZIP, and then our new My Access program. So Irwin likes to really talk a lot about the agency's superpowers, and so as we're talking about single-family programs, I would submit that the superpower that we have is really our access to these low-cost down payment assistance programs. That's what really motivates a borrower to use our programs. Along with that low-cost down payment assistance comes our ability to leverage private capital markets. So our assistance offered through these programs really is just a fraction of the total home purchase price. And with those down payment assistance programs, we're then leveraging the mortgage finance system and capital markets to fund that first mortgage. So what that means is that we can help more low and moderate income households access home ownership with limited state investment. So for Dream for All, we leverage those private capital markets on a ratio of about 5-to-1, but for My Home, that ratio is much, much higher at about 30-to-1. So before I move into program details, I wanted to take a minute to offer what I think is probably an oversimplified review of really the fundamentals of how CalHFA's single-family programs work, and importantly, how we generate revenues in order to keep doing that work. So just to start, CalHFA provides a borrower with access to a low-cost down payment assistance loan. That down payment assistance loan is then paired with a CalHFA first mortgage. And again, it's really that low-cost down payment assistance loan that is the reason a borrower would choose a CalHFA first mortgage. So CalHFA then bundles and sells those first mortgages on the secondary market. And this is really key and kind of the most important part of this overview. So recall that CalHFA does not receive general fund revenues for our operations. We have to generate enough revenue to pay salaries, to pay benefits, to pay all of our overhead costs, to quite literally keep the lights on. So it's this transaction, this bundling and then selling of first mortgages on the secondary market that generates the single-family revenues that the agency uses to fund our operations. Ultimately then, the borrower will repay their down payment assistance loan and those funds will be recycled to help the next home buyer. So what does this all really mean? Why is this important? It means that there are a few imperatives to the CalHFA business model that we have to think about as we're talking about single-family programs. So first of all, CalHFA is actually statutorily prohibited from being a direct lender. So those down payment assistance loans and first mortgages that I just talked about are actually originated by our network of CalHFA approved lenders. So what are the implications of that? So that means that our lender network and our lender partners are the single most critical single-family program partner. Those lenders do not have to offer CalHFA programs and products. So we have to make sure that as we're designing programs, we're making sure that those programs and those products are easy for lenders to use, because without those lenders, we can't offer our programs. Secondly, and with some caveats and exceptions related to occasional general fund allocations and taxable bond programs, CalHFA only has funding for down payment assistance, not first mortgages. So we rely on the secondary market to provide that funding for first mortgages, and on that secondary market transaction, as I just described, to generate the revenues that will support our CalHFA operations. So for mortgages funded by taxable bonds, like the new My Access program, we rely on GSE guarantees for our mortgage-backed securities. So what does that really mean? That means that we don't set all of the rules regarding eligibility for first mortgage financing. We have to follow rules that are set by the insurers and the guarantors of our loans. So in other words, we're talking about the GSEs, we're talking about FHA, USDA, and VA. If we don't, then we can't sell those first mortgages on the secondary market, and the GSEs won't guarantee our mortgage-backed securities. And if the GSEs don't guarantee our mortgage-backed securities, then investors won't purchase our bonds. So lastly, one of our major program constraints is, again, other than funds that are available for specific down payment assistance programs, namely Dream for All and My Home, we do not have access to low-cost capital or general fund support for our core programs and operations. So what that means is that our individual programs have to generate enough revenues to fund operations, and ideally to recycle funds so that we can help more homeowners and operate sustainable programs. So that also means that our loans have to perform well in order to keep our programs afloat, and our risk tolerance really reflects the need to minimize defaults and delinquencies so that our programs can sustain and endure over the long term. So I'll move now into some historical metrics for our current and recent past down payment assistance programs. So here in this chart, we're looking at our historical single-family lending volume relative to our business plan goal over about the last 10 years. The lending goal is shown by the orange line. The historical lending volume is shown by year in the blue bars. So as you can see, fiscal year 2019-20 was our banner year where we generated the most first mortgage lending volume ever at $4.1 billion. That was really bolstered by extremely low interest rates. And then we saw rapid home price appreciation, the COVID-19 pandemic, and that really dampened our performance in the years that followed. But we were able to bolster our volume through both Dream for All and other specialty programs that kind of helped carry us through there a little bit. So this slide looks at that same data, but this time the blue bars are focused on number of home buyers served. And then the orange line is an overlay of the prevailing mortgage interest rates at that time to try to illustrate sort of how volume is related to market factors such as interest rates. And then we've also identified the COVID-19 pandemic and both phases of Dream for All, which sort of, I think, illustrate how those circumstances affected our volume in those years. So in this slide, when I look at this slide, I kind of really think a lot about why our homeownership programs matter. Even given the current challenging market circumstances that we face, we know that we have one of the most challenged real estate markets in history with extremely low inventory, high home prices, continued elevated interest rates, although we've seen some relief in the last few weeks. We know that we're competing for extremely scarce resources, and we know that there are a huge number of other unmet affordable housing and other needs throughout the state. But what we also know is that we have major challenges in our state relating to equity and the racial wealth gap. The reasons for that are myriad. It's really rooted in years, decades of discriminatory policies and practices. But because home ownership is directly related to intergenerational wealth creation, home ownership is also really at the root of our racial wealth gap. So this slide is intended to demonstrate how CalHFA's home ownership programs over the long term have really helped to move the needle on home ownership over, this data is from about the last decade. So obviously we still have a very, very, very long way to go. And we also know from recent initiatives that the board will hear a little bit more about in the coming months, that at the root of that home ownership gap is really an eligibility gap that we need to address. But that said, when you look at this chart and focus on the communities with the lowest current home ownership rate, you can see that our programs overall consistently overperform in the Black and Latino communities, well outpacing the composition of both California households as well as current California homeowners. So I really want to highlight and underscore that data. Looking at the AAPI community, while many segments of the AAPI community do already have very high home ownership rates, that is not a universal trait, and so we recognize that we may have some ground to make up here, and you'll see a little bit in the data that I'll present later how Dream for All helps us to close that gap a little bit. But we have recently updated our data systems to collect more granular data about the AAPI community, and we'll be looking carefully at those data in the coming years to make sure that we are also meeting the needs of those communities with lower homeownership rates. So moving now into some fiscal year 24-25 metrics. So our down payment assistance programs served nearly 7,000 households, providing $280 million in down payment assistance loans, which translates into $3.1 billion of first mortgage securitizations and $63 million in revenues generated for agency operations. That's 70% of CalHFA total operating revenues generated in the last fiscal year. So this slide breaks down the total down payment assistance loan amounts and borrowers. So we have loan amounts on the left, borrowers on the right, into those respective down payment assistance programs. So what I think is interesting and of note here is while Dream for All constitutes over 70% of the actual down payment assistance loan amounts, because those loans are so large, that actually only comprises about 24% of the borrowers that we served. So the Dream for All data is shown in yellow on both charts. With a much smaller assistance amount, My Home is basically the inverse. So as you can see in blue on the left, My Home was about 28% of total loans, but 71% of total home buyers helped. And then My Access and Zip really comprise just a small slice of our overall production. Those are both third liens. They come with a higher interest rate than just My Home alone, and we'll talk a little bit more about that in just a couple slides. So here, I alluded to this a couple slides ago. We're looking again at the demographics of our borrowers for the fiscal year 24-25 year. So a couple of interesting things here. You can see the influence of Dream for All on the composition of both our AAPI and Latino borrowers. So, can we get that back up? Do you have a handout? So I'll keep moving through the slides if you all have a handout. Let me pull my handout up so that I remember what I'm talking about.
Not quite as elegant, but it'll work.
And I was on page 13? Okay, thank you so much. So as I was saying, you can see the influence of Dream for All when you're looking at the composition of AAPI and Latino homebuyers for fiscal year 24-25. This is largely an impact of those geographic set-asides. And so you start to see the composition of homeowners or home buyers looking more like the composition of California households, because we are shifting demand through the Dream for All program to the coastal areas of the state, which look very different than the composition of our typical market area, which is really the central areas of the state. You can also see that over the last several years, the Black and African American numbers are down somewhat from our historical trends. This is a trend that we've been seeing over the last several years since home prices have so rapidly appreciated and interest rates went up. And now we're seeing other economic factors like growing unemployment starting to exacerbate that trend. So that's something that we're watching very, very closely. But this also sort of tells the flip side of the geographic set-aside story, where with Dream for All, because we have the geographic set-asides in Dream for All, that's really helping us to shore this number up and help us to avoid further declines that we might otherwise see if we weren't able to offer that large down payment assistance program. Okay, so moving to the next series of slide, we're going to move into some specific My Home Zip and My Access details. So My Home is a second lien loan that provides up to 3.5% down payment and closing cost assistance. So like most of our loans, it's a silent second loan. It means there's no payments on the loan until the borrower sells or refinances. And then at that point, they pay this My Home loan back at a simple interest rate of 1%. So it's very generous. Zip and My Access then are complements and are additive to that My Home assistance. Zip offers an additional 2 to 3% just for closing costs, and that's paid back at 0% interest, hence the name. It does come with a higher first mortgage interest rate. So oftentimes you'll see that the rate on a Zip loan is 75 to 125 basis points higher than just a My Home down payment assistance loan alone. So what we saw, and this was one of many reasons that we brought the My Access program forward, but when interest rates started to go up, that Zip product became a lot less viable. We simply could not go to market at the interest rates that were being generated for the Zip product. So because the My Access loans are instead funded by the issuance of mortgage revenue bonds, the interest rate for those loans is based on the bond coupon rate, which is typically somewhat higher than My Home alone. But what we generally see is that My Access production is going to follow the distance between a first mortgage with a My Access loan and a first mortgage with a Zip loan. Now that said, My Access does have some increased flexibility in terms of how the assistance can be spent. It can be spent on both down payment and closing cost, while Zip can only be spent on closing cost. So even as interest rates are coming down and rates on Zip are coming down, we do see continued uptake of that My Access product because of the additional flexibility. So if we go to the next slide, key metrics.
Chair Cervantes, can I ask a question?
Thank you. Director Sotelo has a question.
Just a quick question. What's the correlation between the higher interest rate on the Zip loan and the Zip program itself? Or is it because the lenders are trying to increase the rate to make money on the Zip loan?
No,
or
we
it's
set,
additional
yeah,
risk?
we set the pricing on the loan, and we also set lender compensation. So effectively, for the Zip product, the way the additional 2 to 3% assistance is funded is through an increase on the interest rate. So it's effectively a premium priced program, whereas on My Access, we're funding that additional assistance through the issuance of taxable mortgage revenue bonds.
Okay, so it's not like we have program income that we are putting into the Zip. We're actually creating
The funding source
revenue-
is the
the
first
revenue
mortgage
source.
itself.
I understand.
Yeah,
Okay.
yeah.
And to follow on, that's that extra 75 basis points or whatever on the first mortgage.
Correct.
Yeah,
Yeah,
okay.
that funds the zero interest, 2 to 3% additional closing cost loan.
Actually, maybe I could just pause for a second because there's a lot of information here. Anything maybe to this point that individuals might have questions on? I don't see anything.
I did have another question.
Okay, there you go.
Is there a reason that we are using our mortgage assistance product through lenders as opposed to going through nonprofit organizations or CDFIs to deploy that product? Does it have to be with the lender, or can we use those alternative vehicles?
I might ask Molly to help me with this answer, but I believe in the, like, we do partner with CDFIs, and CDFIs are eligible to originate our loans. They just have to meet our criteria for originating first mortgages. And so the vast majority of our lenders are, mortgage brokers and traditional lenders, but CDFIs do have the opportunity to come in.
So is there something in the statute that makes it so that the programmatic, the assistance that we're providing has to get attached to a lending product and placed by that same lender? Or is that something just programmatically we've done? Is it possible to give the first time assistance program to a nonprofit to roll out, and then the first mortgage is placed with the lender and a broker like traditionally we find?
So if you recall, back on the early series of slides that I provided, the CalHFA business model is to pair that down payment assistance loan with a first mortgage product. And it's that first mortgage product and that transaction that is how we fund operations. So generally speaking, we won't get borrowers to use CalHFA's first mortgage product if we don't tie it to the down payment assistance loan.
Okay, but it's a business plan as opposed to a statutory requirement.
Correct.
Okay.
Yeah.
Thank you.
I just have a point of clarification on that. So the question was about using nonprofit organizations to provide that, assurance. But if a nonprofit is not a lender or doesn't have the capacity to be a lender, then that really doesn't seem to be in alignment with our goals and our needs, even though they may be well connected to the community, and maybe their role could be an outreach as opposed to being engaged in the lending aspect of it.
Yeah, there's really two challenges. I think you're hitting on one, which is you do need to have a organization that has the competencies and capabilities to actually originate loans. The other challenge is that if we have standalone down payment assistance programs that are not connected to a first mortgage that CalHFA controls, we're not going to get paid back. It gets missed on title. And when that subordinate loan comes due, it's often very, very difficult to chase folks down, even with all the portfolio monitoring that we can do in order to get paid back. So that's another reason that our business model is to pair those two loans together so that we have the assurances that we're servicing or our servicers are servicing that first loan, which ensures that we get paid back on the second.
To Director Williams' point, though, and to, because I like to call him out as much as possible, Director Russell's guidance, we do engage in nonprofits and CBOs through, I think the point you were making, through communication efforts, through engagement with our products and programs. Those are things we've learned very much to rely on during the relief programs, and things that we are broadening our outlook on all of our program and materials, from like a financial literacy, readiness component. Those are all things that we are striving to broaden our horizons on in that way. So engaging that community is essential for us. It's just not from a like a block grant down payment assistance program perspective.
No, take the pause here. Any other questions at this point? Yes, Council.
Not sure if this is working. Maybe not be working. I'm pushing as hard as I can. I just wanted to mention, sorry, Ellen, if I'm adding maybe additional information that is not pertinent right now, but historically, to your question, Director Sotelo, when CalHFA decoupled its down payment assistance from its first liens, what happened over and over again was that the homeowner would get into trouble, sometimes would go into default. We wouldn't know about it until it was too late. You know, the house would be on the trustee sale block. When the first and second are coupled, we find out much sooner in the process, of course, that there's an issue. And we've been pretty effective over the years in helping people stay in their homes through loan workouts, forbearance, and other opportunities that would have been missed by the agency had those two products been decoupled. Thank you.
Thank you.
All right, it looks like we're back up.
Yep, great.
Okay. So this slide is looking at some key metrics specific for the My Home, Zip, and My Access program. So with these programs, we served over 5,000 borrowers with the My Home program specifically. We had about 200 additional borrowers also take out a Zip loan, and then another 100 borrowers also take out a My Access loan. And then just as a reminder, we launched My Access in March, so there's really just a few months of My Access loan activity in this data. So the average loan amount for My Home was about $15,000. Zip added $9,000 on average, while My Access offered an additional $14,000. The average home prices across these programs are pretty consistent. My Home comes in at about $462,000, Zip at $432,000, and My Access at $424,000. So turning now to some notes on geography. So what this slide shows is the compositions of households. Households are shown by the blue bar, as compared to the composition of My Home, Zip, and My Access loans. So those are shown in the orange and yellow. Again, only a few months of My Access in this data. So I think what we're seeing with My Access is probably pretty highly reflective of the real estate dynamics in those few months. But really overall, what these data underscore is what we've known for a long time, which is that the My Home program performs best in the inland areas of California. So that's the Capital Region, Central Valley, Inland Empire, and rural areas. Those are generally the areas where we see home prices are more affordable to a low and moderate income borrower, and the down payment assistance with My Home is less generous than something like Dream for All, and so it's really helpful to get folks sort of over the hurdles in areas where homeownership is more affordable. So Zip and My Access really follow similar trends. You can see, there's some regional variance in terms of Zip and My Access relative to My Home, but I think that at this time we really don't have a large enough sample size to make any big conclusions. So looking at geography just a slightly different way. These are the top 10 counties for My Home, Zip, and My Access. And so what you can see is the order shifts around a little bit, but we've basically got 7 counties that are on every list in terms of the top 10, and then there's another 4 that show up on 2 of the 3 lists. So there's really a great deal of consistency in terms of where these programs see the most uptake. And one thing you'll see is Los Angeles does come into play on each of these lists. Most of the other counties, other than Contra Costa and Solano, are within that central area of the state. Los Angeles really comes into play just based on sheer population size and volume. Okay, So I will end here with some thoughts regarding how we think about new programs or changes to our existing programs, and really kind of the overall strategic direction of the division. So there's not necessarily one set of right answers to these questions, but what we're really trying to get at with this set of questions is the trade-offs that I think we're starting to have the discussion about here that are really inherent to balancing our mission with our financial sustainability goals. We want to make sure that we're really thoughtful and deliberate and consistent regarding how we go about making those decisions and addressing those trade-offs, and importantly, how we communicate and talk about those decisions. So first and foremost, and I think obviously fundamentally, is how does the program support sustainable home ownership and our policy goals surrounding home ownership? Also very important is what is the funding source? What's the funding source for the subsidy loan? Is the funding source one time or is it continuous? Will those funds recycle? And critically, as I think we've highlighted, is what is the funding source for that first mortgage? Third, and this is really tearing off the conversation that we started to have in the strategic plan board workshop last month, but does CalHFA have the expertise and competency, or we talked a lot about capabilities last month, to administer the program, to implement and administer the program? So we can take that literally, but it also can refer to things like our statutory authority, our existing infrastructure, the staff resources and bandwidth that are available to us in terms of, the capability or competency and expertise to stand up a new program. Fourth, does the program cover CalHFA's operating costs and lending risk? Does it erode our current operating revenues? So again, because we are self-funded and we can't rely on general fund revenues to fund our operations, that's really a critical element of maintaining our agency's financial sustainability. And then finally, what are the other risks to CalHFA from the program, and can those risks be mitigated? That could include things like legal, reputational, market risks, political risks. But back to our earlier discussion, it could also include lender risk. Will lenders use the program? Can we implement a program that is easy for lenders to use? Will it at all degrade our reputation or affect our reputation with those lenders and impact their interest and desire to use our other programs? So those are all the kinds of things that we have to think about. So again, I really want to reiterate that there's not one set of right answers, and there are trade-offs that we make every day when we're looking at new programs and new interventions. But I just think that I want to underscore that these are the kinds of questions that we need to ask ourselves as we're looking at these various home buyer assistance programs, and we're really seeking to balance our policy goals with our financial and business imperatives. So I will stop there. Happy to take any questions.
Thank you. This is a very thorough presentation. Yes. Oh,
I'm raising my hand for Norena, so when you want to call on her, she does have her hand up.
oh, perfect. That's great. I was going to ask for comments from the board, and I will pass it to Norena Limon, because she put her hand up virtually.
Thank you so much, Chair Cervantes, and I wanted to thank Director Martin also for this wonderful presentation. I think it really breaks down in a very digestible way the critical role that these programs play in the success of CalHFA's ability to do all of the work that it does. I think it was it's important for all of us to receive this information and break it down to basics, as you did. And I think I wanted to also highlight the importance of ensuring that our products have a comparative advantage in the market, which we've seen in this high interest rate environment and this affordability crisis that we've had over the past few years. You've seen that CalHFA's products have created a comparative advantage for individuals, particularly in that inland region that has become one of the most critical areas for advancing home ownership for communities of color, especially in the state of California, which is critical for the overall home ownership rates of the state. So your point about the criticality of that custom our lenders is so important as we think about how we continue to iterate and we continue to think about how we can offer better services to our, I mean, and I've seen all of you do extensive trainings. I've heard lenders talk about that, that access and that education that they've received from all of you, which has been critical to their ability to serve communities, especially first-time home buyers. So again, I also wanted to underscore the conversation we had earlier that yes, in terms of the CBOs and the CDFIs, they play a critical role in marketing and in disseminating information about access to CalHFA programs to communities, particularly first-time home buyers. So that is all I wanted to say. Is just I think in terms of when we think about these questions, is just how do we and I also want to thank you for being responsive to our asks to give us some data on how My Access is working. But I really want to commend all of your work on this. And I think as we think about strategic planning, we continue thinking about how do we do even better in terms of creating more streamlined processes for our lenders. How do we ensure that our products create a comparative advantage in the market, especially as the market changes a little bit with interest rates? And how do we uplift what we do best, which is serve that inland area? And how do we do that even better? I think is critical for the overall operations of the organization. So just my 2 cents. Thank you.
Thank you, Director Limon. Other questions or comments from the board? Director Williams?
Well, in my previous life, I was a president of a home building company that focused its primary market on first-time home buyers. So always, this is an area that's near and dear to my heart. But what we have been able to do, Ellen, that you've explained is really remarkable. In a state that has one of the highest cost increases for home ownership, the level and amount of assistance that first-time buyers need is at an all-time high because of the price increase. And just to hear you, I know you said this is a high level, very, very simple, but I agree. This presentation really here kind of sets a clear understanding of what the opportunities are and the challenges. And clearly, we're making an impact for first-time home buyers, but I also acknowledge the importance of us being able to be sustainable ourselves. You've mentioned multiple times that we don't receive funding from, the general fund, and in many ways, that is a blessing because it allows CalHFA to be innovative without being saddled to decisions at other levels that would negatively impact. We're in a deficit. And if we were tied to the general fund, our programs would be subject to the rise and fall. And I know that puts us in a very tenuous situation, but with clear leadership and the innovation that we have, I think it separates us from the challenges of the rest of the state and allows us to move forward with clear, focused vision. So I just want to, again, acknowledge the work and the staff. This is hard work. And to get the numbers that we have seen, I know there's always room for improvement, always. But I'm one of the people who always say, let's celebrate the success as we look toward the future. And this is worth celebrating. And I agree with our chairman, Jim, that celebrating last night was an incredible opportunity. But we're making history right now. And in the coming years, we'll be looking back on the programs that happened after COVID-19. And these will be the programs that others will highlight as CalHFA's one of highest moments of achievement in the face of incredible obstacles. So I just want to say thank you.
Well said. Thank you, Director Williams. Director Russell?
Yes, thank you, and thank you to my colleague, Mr. Williams, here for that. I really appreciate your comments, and we'll commend Ms. Martin and your staff for what you've been able to do. And I've watched through the, forgive me, the program where we're protecting people's homes. The names are jumbling around, but how you went about iteratively as we corrected the program with Dream for All, how we did an iterative process to reach our target audiences. And I think that you said earlier that our superpower in this program is the low cost of the mortgages that we can provide. I would say two other things are really our superpowers: the staff that you have assembled and the work that you do, and then the network of relationships that you've established with the CDFIs, with the CBOs, and that was really evident in other program areas that this was important. And what I want to ask is whether how do we continue to cultivate those relationships? Because it isn't a static thing. What is the ongoing kind of process, and how do you conceptualize the cultivation ongoing?
So if Molly would like to come up and add to this, I think she deserves all the credit for the answer to that question. So I'll start while she gets up here. But this is Molly Ellis. This is what she does, and what her amazing team of outreach and lender trainers do is work with the not just lenders, but also the CBOs, the CDFIs, other advocates, in order to get out there on the ground talking to potential first-time home buyers and helping to educate them about CalHFA programs and get them connected to a lender. And so I'm sure you have a lot more to say about that.
I knew you were going to try to get me up here. Good morning. Yes, though that is, so Molly Ellis, I'm the manager over lender services, training and outreach on the lender services side of the agency. So relationships are my game. That is exactly what my team and I do. Relationships with lenders, relationships with our CDFIs, relationships. We did a whole campaign to bring on some credit unions recently. So we were able to get Golden One. That was my big fish, if you will, for my career. I was after them for a very long time. So super happy that they were able to join and be able to offer the CalHFA suite of programs to their members as well. So definitely trying to the advocate side. So we are at the California Association of Realtors Expo right now. We have staff down there. We are transitioning today over to the NAHREP National Convention. So these are the relationships, and we're speaking on a panel at NAHREP. Leanne Walker, one of my staff, is speaking today, or tomorrow. So yes, relationships is prevalent and I was so happy to hear Rebecca talk about being able to meet with our lender partners last night and to be able to see that side of the house. Super cool, because those are the relationships that I have worked on for so many years, and my staff has worked on for so many years.
Great. Thank you for that response. I think it deserves to be highlighted, the work that you're doing, and I think is, again, one of our superpowers. So the second, I have a question, which is when you talk about the eligibility gap. So condominiums are oftentimes the stepping stone toward single-family home ownership, or an end unto itself. Could you talk a little bit about the proportion of condominium versus single-family home? We make loans in both areas.
Yeah.
And the constraints that you may find.
The proportion of the predominant product type that you see is a single-family home. We do have, a smaller contingent of townhomes, condominiums, et cetera. But condominium financing, actually condominium construction and financing, face significant and unique challenges that make it extraordinarily hard for folks to access. So we're talking about things like construction defect liability, which really inhibits the production of new condos. And then there are some federal rules around financing for condos that make it extraordinarily challenging to actually access financing for condos. So both of those topics are something that we are continually addressing with our various partners throughout the ecosystem, because we would really like to see a lot more condos and townhomes getting built, because it's that entry-level housing that our folks can afford to purchase.
Thank you for that response, because I think with the legislative update that's coming, I think one of the things I would encourage us is to use our political heft, such as it is, to see if we can improve some of those. If there's legislation we can sponsor, if there's other activities we can take. Because especially in an area like San Diego, we have maybe 40,000 single-family home lots to be developed ever remaining. And the developers release them slowly and at very high prices. If we're going to meet the need for ownership, it's going to have to be in multifamily ownership, and we have to create new opportunities, not simply help some families. We need to increase the opportunities. So thank you for that, and thank you for the opportunity.
Thank you, Director Russell. I think, Dr. White, you had a question? Yep.
No question, just wanted to follow up on the outreach discussion, specifically regarding the CVOs, the CDFIs. As I listened to the discussion on how we've been able to leverage those relationships on the single-family side, I can't help but see opportunities where we can leverage these relationships from multifamily and in a capital world. So I want to make sure we're broadening our thoughts around relationships, because I think as we think innovatively, some of those types of partners will help us think through some of the different innovations that we're contemplating. So.
Thank you, Dr. White. Any other questions, comments? Oh, question, Dr. Kurgan.
Thank you, Ellen, for the presentation. Molly, thank you for being here and clarifying. Building on what Director Russell shared, I was wondering if NCSHA or others have advocated to the federal government about changing GSE standards for condominiums, and maybe that would be a helpful follow-up just so we can understand what some of those barriers are, because I do understand that there's greater production in other states, one. And then second, we have the Affordable Housing and Sustainable Community Program and others that allow for home ownership, and most times that would be, I think the developers would lean towards multifamily home ownership. So to make sure that the efficacy of those programmatic carve-outs are working and we're achieving those goals, just like to be clear with all of our other partners in state government who don't have the expertise that your team carries. And to that, want to echo the thanks that you've heard already, but for the presentation, for the ongoing work and the incredible relationship building that you're leading. Thanks.
Thank you, Director Kurgan. Dr. Hardman, do you have a question?
Yeah, I just quick, and forgive me for being a novice here on home lending, but are all the borrowers in the My Home program, are they getting FHA backed loans, or are there any conventional loans that occur?
It's a mixture of both. I think we're at about a 70-30 mix or 60-40 product mix on FHA versus conventional. Mm-hmm. But we offer FHA, Fannie Mae, USDA, VA, and what am I missing? FHA. Did I not say FHA? Yeah.
So and on the loans that are being, the first mortgages that are being backed by just a 3.5% down, what's like the time frame in which we see those homes, those loans being refinanced? Like how quickly are they happening faster, I'm guessing, than the conventional loans that are happening under the program?
So generally speaking, what we see is both FHA and conventional loans. Average life cycle of a mortgage tends to be about 7 years, and we tend to see that. We're expecting on Dream for All limited data on shared appreciation loan programs, but it looks like shared appreciation loans folks hang on to those for a longer time because they're large loans that they can't refinance out of quite as quickly. But it really follows the market cycles. So as you see interest rates go down, then you're right. Folks will try to refinance out of that My Home subordinate loan on both the FHA and the conventional side. And so once they can achieve, cost savings relative to the interest rate and monthly payment on those.
Thank you.
Okay, thank you. Other questions or comments? Yeah, Director Fano.
Okay, is that better? Okay, great.
That's great.
More, I guess, for my own edification, somewhat new to the process, but are these loans stackable? Meaning an applicant could apply for all three, the My Home, the Zip, My Access, are they separate, and is it a single application process? Just curious, kind of logistically, how that works, and forgive me if that's common knowledge.
No, that's a great question. So no, you cannot combine My Home and Dream for All. You can combine My Home and Zip, and you can combine My Home and My Access. So those programs are stackable to get up to, and I didn't say this, I'm sorry, I should have, but to get up to a total of 6% in down payment assistance. They are also stackable with other down payment assistance programs that might be offered by a city or city, county, or other local government entity, so long as those other programs are in a lien position behind our second lien. Was there another part of your question that I missed?
Yeah, I think, and then the application process.
Oh, the application
Yeah.
process. So basically, the borrower accesses these programs through applying with their lender, with their CalHFA lender for. So as they're going through that process, then their lender will seek to reserve them a loan in our system as well. So it's pretty seamless.
Okay, great. Thank you for that.
Thank you. Other questions?
I do.
Director Sotelo.
Thank you again, Eileen, for all your critical information. It's always very helpful. Back to the point around diversifying our lender pool, I appreciate the clarification on why we place both loans together and following up on, necessarily keeping the default first and foremost in our mind. One of the things I'd like to explore, and maybe this is more of a business planning effort for the board, but looking at organizations like Neighborhood Housing Services, that is throughout California. There's one in all the major cities. They offer a loan product, and their buyers are typically communities of color as well as lower income communities. And what I like about their program is they have ongoing, continuing support for the first-time homebuyers. So from an education standpoint, it really falls to them to continue that relationship and releases us of the burden of having to do that. This all, to me, kind of became clear yesterday. I spoke to two of our mortgage partners during our gala yesterday, and both of them had said that their education programs have dropped off. And I was very surprised by that, right? Because as private lenders, they don't have an obligation to keep ongoing education and support to homebuyers as part of their mission, right? And a CBO and or CDFI does. And so that to me is a reason why I'd like to look at our, diversifying our lender pool to include some of the lending organizations that would potentially be able to have continued support to homebuyers, and then also have a different audience, right? One of the things that I think would be helpful for me to understand is our vendor pool, like our vendor pool. And Molly, congratulations on your 27 years, and congratulations on the credit on getting a credit union, because I know that was very hard. But do we have a sense of the areas that they focus on? Do we have a sense of whether they're small brokerage firms or larger brokerage firms? Do we have a sense of whether they're, small enterprises or MBWBEs? Are those lenders, conglomerates? Are they individuals? So just getting a sense of who our vendors are, who our extended lender pool, what their profile looks like, I think would be helpful to me. And then I'm not sure who made the point earlier, but the ASIC program has, renewed at $800 million on an annual basis, I think, right? Going forward for the next 10 years. There is an untapped resource for for single family development and first time home buyers. We're not going to be able to access that capital as a development community until we have kind of a broader sense of how we place mortgages and how we provide first-time home buyer assistance as a package to developers who can build those units, right? And so I think creating a pool where we do a set aside for development and developers that focus on, large-scale development, that focus on first-time home buyers, and maybe do a pilot program that just supports that effort, puts us in a unique position to be able to kind of move the ball forward. 7,000 households, 7,000 loans that we made, that we placed, that we were successful doing was fantastic, but it's a heavy lift to touch 7,000 individual buyers as opposed to, touching 5 developers that can build, 1,000 units of housing. So that's just my 2 cents. And, as we think about it on the board level in our business planning, I don't want to affect the revenues because 70% of our operating budget is huge. But I also want us to be able to, look at how we can leverage our superpowers to build out a different program.
Thank you. Other questions? Ellen, I have to say, really great presentation. This is really thorough, and there's a lot to chew on here. One of the graphics that really struck me was the one where you overlay interest rates with production, and you could sort of see the effect of having sustained 7% loan rates, what that does. I'm kind of impressed that we were able to keep it up as much as we had. I guess Dream for All was a part of that. So obviously the markets creates a headwind right now. Mm-hmm. What's your sense? I mean, if rates came down by, 100 basis points, does that start to move the dial again? I noticed before the pandemic, and we were at in the 4s, it seemed, and production was higher. Is there a point is there a tipping point, do you think, in terms of this program really taking off again, or?
Yes, I think so, and I think as interest rates stabilize, I think, throughout my career, I have yet to see that perfect, sustainable real estate, single-family real estate housing market. So, so I'm not going to pretend that that's going to come back into equilibrium at any point. But I do think that as we see interest rates come down, into where they're hovering around now in the 5 to 6% range, I think we'll see some sort of stability. But what we'll also see that's really important for our programs is increased refinance activity. And the reason increased refinance activity is so important is because that's how we basically recapitalize our availability of funds for down payment assistance. So that's what I think the primary effect of recent interest rate declines will be, and we are actually starting to see some increased refinance activity with our new suite of refinance offerings.
Okay, that's helpful. So just I don't know, like if we were to say we wanted to allocate, I don't know, 50 million off balance sheet to further these programs. I want to get to your point 4, which is, does it cover our operating costs and lending risk? Is that a viable proposition, or is there like a shortfall there in terms of like the return relative to what we would inject?
I was looking to see if Erwin was going to come push me out of my chair.
Okay. You gotta get the jacket on.
So.
I think it's also a numbers game. I think 50 would be way too low. I think you need to add like a 0.
Okay. All right. Thank you.
Can answer that very quickly. So, down payment assistance by nature of the 1%, is underneath the taxable bond execution is not financially sustainable for the agency. So.
Okay. Thank you.
But can you give if we wanted, we would need like 50 just to set the stand, like 50 wouldn't move the needle of an amount. We would need a much higher amount to infuse in.
It doesn't matter what the dollar par amount is off balance sheet. By nature of the down payment assistance provided, it is not financially sustainable for the agency to contribute that into this type of program. We can contemplate other ways, but within the My Home program itself, in the 1% deferred, it's not financially sustainable.
Yeah. Okay.
To ask the question, may I ask?
Please.
To ask the question another way, will it programmatically be break even if we're able to recapture and repay under a refinancing program?
It would not.
Okay.
Okay.
And so when we talk about the proceeds of $63 million being generated by the program, it's because we have the first mortgage attached to that, and that's what generates the dollar value.
Yeah.
Okay, so if we did the $50 million on its own, it wouldn't make a difference. But if we did the $50 million coupled with a first mortgage, that leverages it higher up.
No, right. And so the margins we receive from the executions underneath the first mortgage program do not offset the cost of a subsidy program as currently designed with the 1% deferred that is My Home.
Okay. Yeah, I think that's what I was trying to get at.
Yeah.
Thank you.
No problem.
Okay. And then maybe the last thing is, and Ellen, you touched on this, your last point, additional risks. Where are the risks in this? I mean, I'm really impressed with the performance and the design of the program and all that, but are there things out there that we should be mindful of? I mean, there's the known knowns, and then you get to the unknown unknowns, but is there, in that spectrum, something we should be paying attention to?
That's a great question. Supply is, I would say, the number one challenge and risk to the program. Seeing sort of ever increasing and elevated home prices just continues to make it more and more challenging for low and moderate income home buyers to get into this market. So I would say that's number one. There's also repayment risk. So anything that makes it that is disruptive or threatening to the homeownership market, like our insurance crisis, that might interfere with repayments, would also be something that we want to keep a close eye on.
Okay. All right. Thank you. Before we go to any public kind of comment or question, I'd like to see if there's any other board members who want to ask a question, make a comment. I don't see anyone. Courtney, can you please see if there's any public input on this agenda item?
If any member of the public would like to comment on this agenda item, please raise your hand or come forward. There's none at this time.
Great. Thank you. Very thorough presentation. Thank you very much.
Thank you.
Very helpful. Thank you. Item 10 is an update on the legislative session, which just wrapped up on Friday. Our Director of Legislation, Meji Tabar, will give us the update.
Oh, is this your phone? All righty. Okay, good afternoon. I've been waiting a full month to present to you all. I was supposed to present last month, so excited to be here to update everyone on the legislative session. As most of you know, my name is Meji Tabar. I am the Legislative Director at CalHFA. Just a quick reminder, my job here at CalHFA is somewhat unique. My role is really to monitor and advise on relevant legislative and political and policy matters, not to give opinions and feedbacks on active legislation. That's particularly important as where we're at in the legislative session, which I will get to in a moment. So let's see. All right, so real quick, as the chair mentioned, we just wrapped up the legislative session very recently. I know my legislative friends are all very tired from a very exhaustive session, but where we're at right now is all the bills that have made it through the second house are now going to the governor's desk, and we await to see the outcome of those bills that have made it to his desk.
So this, as a reminder, this is the first year in a 2-year session. And so the legislative, the second year in the session will pick up back in January. I have mentioned a number of bills that have a direct impact to CalHFA previously. Just wanted to flag kind of where those are at right now. First and foremost is Assembly Bill 57 by Assembly Member McKinner. This is the set aside in Dream for All for descendants of formerly enslaved persons. This bill did make it through the second house and is on the governor's desk. So we will await the outcome of that bill. The other bill that I know folks have had a lot of interest in, because it directly names CalHFA, is Senate Bill 750 by Senator Cortese. This was the Loan Guarantee Credit Enhancement Program. That bill actually got held, and so we may see that come back up during that second year in the legislative session. So that's kind of put on pause, and we will await to see where that bill lands next year. And then finally, AB 736 by Assemblymember Wicks and SB 417 by Cabaldon. These are the partner housing bond bills. These are continuing forward. They are technically a 2-year bill, given that it will be a ballot initiative, and so we will see that come forward next year. But as far as we know, that continues to move forward. Real quick, there were a number of other bills that I have mentioned previously, and if I have not mentioned them here, it means they have not proceeded in either house. So I think there were a number of AI bills that I had flagged previously, and those have not proceeded. But I anticipate we'll see more in the future. Of course, I think the federal update is where most folks are really interested in, and given that I have not presented to the board in a number of months, I'm going to kind of take a look back in where we've kind of been at the federal level in terms of legislation and budget. And so as a quick reminder, back in July, the president signed a reconciliation package. Agencies are now issuing guidance and rulemaking to implement. We know California has put out guidance on tax credits. And so we're continuing to look at the impact there. I think we're obviously most interested in the low-income housing tax credit and the potential opportunities there. From estimates so far, it looks like these changes to the housing tax credit world could bring in, at least right now, over 200,000 new rental homes in California, 300,000 new jobs. And so I think there's some really exciting initiatives. To be more specific, there's a permanent 12% increase in the Housing Credit Authority. This is about the 9% tax credit. I won't get into all of that right now, but obviously this will be important as we're looking at our multifamily portfolio here at CalHFA. And then the other really important component here is lowering the bond financing threshold from 50% to 25%. This has to do with the 4% tax credit program. So again, I think these are all really exciting new opportunities in tax credit world. There are a few other things here that I won't go through in much detail, but all to say there are some other changes to tax credits that might impact the investor interest in tax credits. We know, at least on face value, more tax credit in the market may impact the price of tax credits. And so a lot of folks are interested in what the price change in tax credits might do to investment interest. But I will say there are a number of initiatives put forth in the reconciliation package that are trying to get at that investor interest to try to stabilize the market. So a number of things that we will wait to see pan out. But I think as we all are really excited to hear about the changes in low-income housing tax credit, we will wait to see the impact to investment. I know this has been a hot topic. Again, it's a few weeks old now. The Road to Housing Act, this was housing bill that made its way through one of the policy committees relatively recently. It's a really big deal in the sense that it had bipartisan support. So I think that is the really exciting component to this bill. We obviously don't see a lot of federal legislation kind of making it to the finish line, but there are a number of initiatives in this bill that are really exciting, whether it be about the Community Investment Act or potentially streamlining NEPA, continued interest in opportunity zones and rural areas. We've heard some things. Well, I not as relevant for us here today, but the home program has been top of mind at the federal level. And so this bill has a number of initiatives around home. But all that to say, I think this is a really exciting bill, at least in the bipartisanship interest in these housing initiatives. So in terms of the future of the Road to Housing Act, it still has a number of hurdles to pass through. I believe it's currently on the floor. I forget exactly where it is right now, but I'll let you all know where it lands the next time that I give you an update. Oh, I see there is a comment or a question, and I'm happy to take it.
Sorry, Meji, I just
No,
wanted to go back
please.
to I wanted to go back to the Road to Housing.
Yes. Oh, yeah.
Other key developments in here is that there is some critical language that folks, including my organization, we're working on, including language that would open the doors for ADU financing. And then also there's changes to the way that chassis are categorized, which opens the door for a lot of manufactured housing. So those two key issues, I think, directly impact the work at CalHFA, and that's something that we're watching very closely.
Great. Yeah, thank you. Thanks for flagging that. Any other questions right now? Oh, yeah.
I overheard or was told a pretty astonishing figure, the positive results of the change in the tax
Yes.
credit threshold. Maybe you could share the actual impact. I think, Marina, it may have been from you. Probably.
Oh, yeah, please.
Yeah, so I think, and I mentioned this at the board meeting back in July, we put out, and the board, our committee adopted emergency regulations on August 5th, so a month after the One Big Beautiful Bill passed, implementing the 25% test for round 3 of our bond and tax credit program. That that had applications due September 9th. So very quick kind of turnaround for that. Along with that, we had proposed, we were in the middle of round 2 when these changes were made. And so we proposed an voluntary incentive program to get round 2 recipients of bonds and credits to voluntarily reduce their bond allocation amount to meet the 25% test, since those projects are generally scheduled to close in 2026 and therefore would be able to take advantage of the 25% test. As a result of that, we had $600 million in bonds returned that we were able to redeploy for round 3. And so we had $2 billion in tax-exempt bonds available for our round 3. We had $3 billion in requests, so that's actually sort of one of our best sort of in terms of competition, sort of highest chance of winning in a long time. My staff is currently processing the applicant list right now to get our first sort, but I think what the results will mean as a result of this is that most projects that came in round 3 that did not have state tax credit requests, since that was a more limited resource than the bonds this round, will likely be able to move forward this year. So great news, but to Meji's point earlier, with the influx of all these sort of extensions on tax credits and with the potential doubling of what we can do on the 4% side, I think the industry generally is seeing an impactful reduction of credit pricing. And so what that practically means is more projects are going to be reliant on additional soft subsidy in order to be feasible. So we're going to sort of see a lot of sort of shifting of sort of the demand happening over the next year and sort of settling into a little bit of a probably different balance in the work we're doing by the end of 26 and into 27. And we're probably going to be doing more rehab deals than we have been in the past 5 years. So we've been really prioritizing new construction because of the large amount of demand for new construction projects and the large amount of public resources that were available in the last 6 years for affordable housing. And so those are sort of waning, and these projects are going to have new feasibility challenges, we'll sort of be seeing a shift a bit.
And I'll just add, CalHFA is still looking at the potential impact to our multifamily portfolio, but there has been a number of times when tax credit pricing has changed, and that has impacted our MIP projects. And there's been a number of ways that we have moved forward, and so I think there are ways that we can look back and see what has done in the past when pricing has changed. And so we continue to look at that, and at least to the best of our ability, try to put out some potential impacts. But I'll just say, it's all relatively recent. Of course, the emergency regs just passed. Feels like that. But yeah, I think we'll continue to look at that impact. Great. All right, I just wanted to mention, and some of these are dated now, but I think they still come up, so I did want to flag them. FHFA has authorized an increase in investment limits for Fannie Mae and Freddie Mac. I think this is obviously really important to CalHFA. We're continuing to look at potential changes to Fannie and Freddie. There's been a lot of mentions of what might happen there, and so our eyes are definitely on that. But the increase in investment caps is good for CalHFA, so something that we were looking forward to. The HUD funding bill, transportation and housing funding bill, continues to advance. Right now, I'm not going to give you the latest update because there are active things happening right now between both parties trying to figure out whether they're going to continue to fund the government or not. So it's hard for me to really predict what will happen there. But I flagged this just to say that a number of HUD programs that were being proposed to be cut did make its way back in, not at the levels that we would like to see necessarily, but at a stabilizing level. And so I think, at least on the face of that right now, that seems to be generally positive. There are a number of executive orders that have come out over the past month. I think the one I flagged here was on homelessness. There have been mentions of other executive orders or national housing emergencies that have been brought up in the past week. I think there's been some other things happening at the national level that have kind of taken away from some of that momentum, maybe to our benefit, let's see. Hopefully there's not as much focus on these executive orders or attacks on homelessness. But all that to say, these are really important things that we're going to continue to look at. As I mentioned in the road to housing, there are a number of opportunities at the federal level when we look at NEPA streamlining. And so, what are the potential things that we could pull out of some of these executive orders is something that we'll continue to look at. And then there has been some proposed rules around eliminating some fair housing and fair lending regulation. We will continue to keep an eye on that. We know these are continued focus and attacks on kind of DEI efforts, and I think this is in line with that. And then finally, there has been, and this has been ongoing for a number of months, but federal regulators are trying to simplify some of the CRA regulations, going back to some of the old rules. There are some mixed emotions around that, but it could potentially impact the lenders that we work with or the banks that we work with. And so we're going to keep an eye on the Community Reinvestment Act and potential changes there. That was a long list of things that are happening at the federal level, but we will continue to keep an eye. I think the good news is housing is on everyone's mind. We heard Senator Wahab last night, for those who came to our big celebration, and she highlighted that at least housing in her district, and obviously we all know this, housing is an incredible top of mind issue for most people. And so we feel that at the federal level, regardless of if folks see eye to eye in some of these policies. And so I'm hoping, again, with the Road to Housing Act, that there is some momentum around some of these good housing policies. So, yep.
Great. Thank you very much. I want to see if there's any questions or comments from the board. I have one. You touched on the Community Reinvestment Act.
Yes.
So they want to, there's a motion afoot to simplify, and I put that in air quotes, the CRA, but there was talk, I think earlier, maybe eliminating it altogether. Is that?
It's trying to eliminate a previous ruling, so it would go back to a more simplified version. I forget the exact year, but it's like a 1990s version of the rule. So it is, I would say, in some ways a simplification, but it would be a reversal of a more recent ruling that was controversial on both sides. Yeah.
Okay. All right. Okay. I'm looking around. I don't see any hands raised. Courtney, can you see if there's any public comment on this item?
If any members of the public would like to comment on this agenda item, please raise your hand and come forward. There's none at this time.
Okay. Thank you very much.
Thank
Yeah,
you.
we'll stay tuned. Item 11, the written reports. There's in your packet, we've got informational written reports. If there's any questions on those, we've got staff here who can answer them. I'm looking to see if there's any board member with a question or comment on the written reports in the package. I don't see any. Courtney, is there anyone in the public who would like to speak on this item?
If any members of the public would like to speak on this agenda item, please raise your hand or come forward. There's none at this time.
Thank you. Item 12, other board items. This would be for items that board members would like to raise that we can discuss at a subsequent meeting where we can agendize it. Are there any topics that folks have that we want to make sure we include in a subsequent meeting?
I have been asked by a couple board members. We will share the videos that we sent or that were shown last night to the board. They were two videos around impact, well, history and impact. So we will share those with the board members. I don't know how, because I'm not a technology person, but we'll get you a video link at some point.
Okay. I expect we'll have an update on the status of that building acquisition project at the next session. And like the Shiloh Terrace issue, will come back again.
Federal updates too.
Federal updates?
Just continue. It's a kind of a nice cadence that we have going, and given that Meji skillfully showed us what may be coming, it'd be nice to kind of close that out, because as Director Limon mentioned, there could be some real implications for some of our programs if we think positively about some of these changes as potential opportunities.
Thank you. That's actually a very good point to raise. So we'll definitely want to keep track of that and bring that up in the next session. Any other items? Yes, Director Russell.
I just wanted to note that I will be missing next month's meeting, October 16th, because we are hosting the San Diego Housing Federation annual conference that day. So I will not be joining here.
I think that's called an excused absence. Good luck with that. Any other items? Seeing none. I don't think we need public comment on this. So then there is public comment on item 13, which is just comment in any topic in general the public would wish to raise. Courtney, is there anyone who'd like to address the board?
If any members of the public would like to comment, please raise your hand or come forward. There's none at this time.
Okay, thank you. And with that, I believe we are at the end. Thank you all. And again, thanks to everyone who participated in the event last night. It was really terrific. Really a great highlight. And we'll look forward to seeing you at our next board meeting. Meeting adjourned.